This is Optimal Finance Daily, episode 1866. Is there a reason you're checking your investments several times a day? By Stein of CashflowCookbook.com. And I'm your host and personal finance enthusiast, Diana Merriam. And we have a new author today from CashflowCookbook.com. I'll tell you more about Gordon right after this post. So for now, let's get right to it and start optimizing your life. Is there a reason you're checking your investments several times a day? By Stein of CashflowCookbook.com. Have you been peeking, checking your investments? Such fun. With just a click or two, you can see what's up and what's down. The bright green confirming your choices, stoking mirages of early retirement, days on the beach, and freedom moving closer. The panicky red graphs conjuring temporary despair, years more of daily grind, and a second career as a Walmart greeter. The drama plays out in a river of dopamine as your body savors the rush of the latest set of numbers and charts. But is there a real benefit to checking your investments? And how often is too often? There's really not much to see and even less to change. Good investing should be boring over the short term. Earning a consistent 10% return would be viewed as beating the market, and earning, say, 12% over time would be truly remarkable long-term results. At 12%, your money doubles every 6 years. Doubles. But even 12% a year is only 0.004% a day. That's really not much to see. It's a bit like watching cold beer evaporate on a hot afternoon, and just as wasteful. Worse still, all of this checking can lead to bad things, like making changes to a perfectly good portfolio. It reminds me of the old joke that the factory of the future will have just 2 employees, a man and a dog. The man is there to feed the dog. The dog is there to make sure that the man doesn't touch anything. In the world of investing, think of yourself as the man. If you have an advisor, part of their role is to be the dog. If the investment portfolio factory is set up properly in the first place, there isn't much to watch and even less to tweak and change. Most of us need that dog watching over us, stopping us from checking our investments too much, ideally biting us on our mouse hand before we log in and change something. Why investments fluctuate? Investment values change as market sentiments shift. Company management changes. Political policies shift. A strong quarter comes in above expectations. A weak quarter comes in below plan. The overall market drops as fears rise over interest rates or inflation. Meanwhile, what exactly happened to your investment? Most likely, nothing. The red graph of despair calls you to hit the sell button. The next day, the graph glows green and a feeling of wellness resumes. When you're checking your investments on any given day, some stocks will be up, others will be down, lots of red and green. It means nothing. It's just noise. The color of fear and greed. If you look at a particular stock, you might see something like this. Bright red, fear, panic. Should I sell now? Why did I buy this dog? How much have I lost? What do I do now? How much further is this thing going to fall? Or you might see something like this. Wow, bright green, greed. How much have I made? Why didn't I buy more? So smart that I picked this stock. I really am an investing superstar. Those stock charts are in fact the same stock, only at different points. We'll use Accenture as an example. The first chart shows the last few days of the stock, while the second one shows the last 20 years. The first one tells us nothing about the company. The second chart doesn't predict anything, but it shows a long-term pattern of growth. Accenture stock has averaged close to 16% annually over the last 20 years. If you held Accenture over the long haul, you would have enjoyed that 16% growth. Hopefully not selling when it dropped during 9/11 or the 2008-2009 financial crisis, or during its big fall as COVID became a reality. Pick a few quality stocks and look at their charts over a short period of time and then again over a long period of time. You will see a similar pattern. Here's some more thoughts. Number 1, if you owned a business, how often would you spend money to have it valued and for what purpose? The likely answer is only if you're planning to sell or merge. When you own shares in companies, you own a piece of those businesses. You've placed your trust in their employees to grow their business. Let them do their thing. Number 2, you should have an asset allocation model for your age, stage, and risk level. Rebalance quarterly to get back to your planned allocation. Number 3, if you look too frequently, you'll fall into the trap of having your moods dictated by the daily ups and downs of the market. Over the long haul, markets rise by about 8% a year. On any given day or week, they could be up or down. There's no meaning in that. Number 4, by checking your investments too often, you'll be tempted to buy or sell by share price movements or by news on a holding or on a stock you're considering. Most of the time, you'll be wrong with those moves, and you'll pay a price in missed opportunity and wasted transaction costs. And number 5, occasionally you may have holdings whose circumstances have changed, and it may be prudent to reduce your exposure. You can guard against that by holding broad ETFs, only blue chip stocks and bonds, or by having a qualified professional manager account. If you hold individual stocks, ensure that you're well diversified by geography and industry. Dividend aristocrats, 25-year rising dividend companies, may also be a good choice since they tend to be high-quality companies with solid returns and growing dividends. Automatically reinvesting those dividends helps reduce risk by dollar cost averaging new purchases. Summary. In summary, build a well-diversified portfolio of quality stocks, bonds, and ETFs that matches your risk profile. Rebalance every quarter. The employees at all of those companies are busy working to grow the company and create more value. Let them do their job. Invest wisely, then enjoy your life. Pursue your passions. Enjoy the days, and help others. Disclosure, I hold a position at Accenture. Nothing in this post should be construed as specific investing advice, just as general information. Investors should do their own research prior to investing. You just listened to the post titled, "Is There a Reason You're Checking Your Investments Several Times a Day?" by Gordon Stein of cashflowcookbook.com. Thank you to Gordon Stein. He's an international personal finance speaker, author, and blogger on a mission to help everyone attain financial wellness. North Americans are struggling with high levels of personal debt and higher levels of stress about money. Their financial worries affect their sleep, their job performance, their marriages, and their mental health. Gordon wants to fix that. Come by cashflowcookbook.com for a lot more articles and resources. And thanks again to Gordon for letting us share his work. I got 3 main points out of this article. First, you need to invest to reach your financial goals. Second, you need to be comfortable with some risk. And third, you need to be in it for the long term. The way I see it, the fact that I'm a long-term investor is intrinsically tied to my ability to handle the risk of investing. I accept that investing in the stock market requires a tolerance for volatility, especially when you have a 100% stock portfolio like I do. I deal with the volatility in 2 key ways. Firstly, as recommended in this article, I just don't watch the roller coaster ride of the stock market very closely. I look at the money I invest like a tax that I'm paying to my future self. I see that money as not really mine, meaning present Diana has no claim to it. So whether my portfolio is up or down doesn't really have an effect on me right now, and I can happily ignore it. Secondly, I pair my investments with a really strong cash position. Most people think that I'm holding way too much cash because I have about a year of expenses just sitting there, earning no meaningful interest. But for me, holding this much cash provides extra assurance that whatever financial needs arise, it's unlikely I'll need to tap into my investments anytime soon, and so I can truly leave them to grow over the long term. A passive investment style, alongside some blissful ignorance and long-term focus, makes the volatility of the stock market much more tolerable for me. That should do it for another edition of Optimal Finance Daily. Have a great rest of your day, and I'll see you on the Wednesday show tomorrow, where your optimal life awaits.